2, 3.
Some of the greatest brands and companies of all time, people like IKEA, Patagonia, Spanx, Trader Joe's, Smart Scout, In-N-Out Burger, Chick-fil-A, Raising Cane's. What do all of those companies have in common? They haven't taken out any loans or venture capital. I have my latest business, Smart Scout, doesn't have any loans, no venture ever. But that wasn't always true with some of the businesses that I have. And I'm going to talk about my Amazon selling business, BuyBoxer, and some of the leverage that we did, why we did it, how it helped us, and actually how it kind of made things hard. I think this is obviously going to be a very applicable topic. And if you stay around to the very end, I'll tell you about Amazon Accelerate, a little announcement going on there. But okay, so let's jump straight in. If you're selling on Amazon, you're going to hit a point at some point where you're like, oh crap, I need cash. I need to buy inventory. Because for our business, like our inventory value had the direct correlation with how much we sold. And so the more money we could put in, the more we could reinvest into inventory. It made everything, it kind of created that flywheel for us. It created where we could do economies of scale. We can have more employees that can build, and it kind of creates that cycle. So, cash infusion, a lot of the bursts in our growth were due to that. Not every single one of them. I mean, we had a lot of money in the early years, where it was actually just like cash that we just reinvested, and it wasn't like leverage. Sometimes a lot of our cash positions just had to do about Q4 and tax season and all that. And so when we were able to deploy it, we would grow. So let's just talk about leverage in your business. I'll talk about BuyBoxers, like the different ways that we had. We had, I think credit cards was pretty normal, whether it's like operating expenses or even buying inventory on credit cards. It did become a strategy. If they didn't charge us a 2 or 3% extra, well, of course we'd buy inventory, because that gives us like 1 to 2%. I mean, using the Spark card, we'd get the Capital One, we'd get 2% cash back. So, not a bad thing. And then, but like credit cards also buy you 30 days. Doesn't hurt. Don't get yourself in a dangerous situation. Well, it's going to be, I guarantee you, if you start down this path, you're going to at some point you're going to cut things really close, because you have to be able to pay that off within 30 days. And it's kind of tricky. If you're getting inventory into Amazon, it could take 2, 3, 4, 5, or 6 weeks to get enough that, you're able to pay off a card. Sometimes a little bit longer, but you get the idea. And that's why actually the Plum card, the American Express Plum card has this flexibility where you can get cash back, or you can extend your month and your terms another month. So we did that as well. And so I'm not really trying to talk about credit cards too much, but it was just a part of it. There was times where we were carrying $500,000 on credit cards. And then also you could use vendor debt. That's where you get terms, net 30, net 60, net 90. And to get that, you usually have to get a credit check. They're putting a risk on you to pay. And again, this is a way to build up, basically your inventory value. You can make money off of, maybe you don't have the cash on hand right now, but you will, based off of your experience, how those things are going to go. Okay. Those are, I'd argue, more about financial engineering. Now, true leverage is where you're taking on just an outside loan. It could be a term loan for a year. It could be a line of credit where you're only paying for the interest of what you're using. And I think we tried a lot of different things. Our first ones were, we would try, you're always going to get the best rates from a bank. And so talking to your bank, they're going to be a little slow. They're not going to understand your business, and they're going to be very risk avoidant. So it took us a few years to get to an inventory-based loan where they'd give us 50% on our inventory value. I think we hit an inventory value of about $6 million, maybe actually probably 7 or 8, and so we could get about $3 million from them. We also we did have another ace in the hole here. That was while it was inventory based, we also did put up some collateral with that. Don't ask me why. It's just, it was about $1 million building that my brother owned, and I think they just wanted to the bank just wanted to cover all of their. They wanted to protect themselves, basically. And it allowed us to get to yes. And it allowed us to get to good rates like 5%, 6%. By using the building, we got it down a little bit. Sorry. I just jumped straight into this, so it may be a little bit overwhelming for some people. But for those that have listened, I already can tell this is a good episode because my experience selling on Amazon, started a wholesale business 2013, grew it to, we had multiple years. We did more than 50 million in revenue, and we scaled it and had a lot of different products. Now, I'm going to tell you, maybe even reveal a few things I haven't talked about on the podcast, the downsides and kind of how I do business now. There's so many downsides to taking on loans or to taking on, that's not backed by assets that are easy to move. Let me talk about there is another category of loans, and I get hit up by these all the time. These are kind of more creative. They could be I forgot the term. It's not it's financed based off of your revenue that you do. Maybe they'll look at your Amazon account and they'll be like, hey, we could offer you this term. Amazon Lending does this. There are lots of other companies like 8Fig, SellersFi. Some of them focus on private label. Some of them just focus on anything e-commerce. Clearco. They're all, in my opinion, they're very similar. It just kind of comes down to what rate, how easy it is to open it up. And boy, do they like to reach out to you. I get a text message every week from someone trying to throw a loan at me. And it's actually really annoying because just not interested. And so kind of just becomes a percent game. You can find as low as 8 or 9%, but probably not anymore. I bet you right now 11, 12% is a good rate for one of those loans. Especially if you're taking out, over 100,000 or so, they're going to be pretty buttoned up as interest rates have gone up across the board. So yeah. Okay. So what are the problems that we experienced? One is, we were tracking inventory value all the time. That basically was our retained value in the business, like our balance sheet. And the truth is, inventory into Amazon is not always what you're going to get back. If you have $6 million in inventory, if that's wholesale price, you could get more than that because, the retail, you could get less of that. There is your inventory health, how stale it is, is it expiring? Some of these issues kind of extend out, and in our experience, so $6 million in inventory, we got back about 4.5, and we still have $500,000 in inventory to this date, 2 to 3 years later. So yeah, you can see that it's a slow grind to go through so many different products. It's crazy. We're still doing about $10,000 to $20,000 in sales a month, and could do more if we really optimized it. It just takes a lot of time and effort, and yeah, I don't put time and effort into it. Another thing is inventory value for an Amazon business. I found for us, it was very hard to get accurate. So many different buckets of inventory. You have inventory that you've paid for that's arriving to you, or inventory that you're like working on, inventory that might be like just like you're storing away. You might have inventory on the way to Amazon and your inventory at Amazon. And as you know, if you've dealt with Amazon FBA, they have a variety of different classifications for your inventory, whether it's reserved. It was hard to really know what your inventory value is. And sometimes these swings could be over $100,000. And so like, yeah, it actually kind of matters. And I think we overestimated our inventory. That was a little bit of our experience. We started to, our loans started to go down, and we're like, I'm going to jump into one other issue about a problem about leverage, about getting it. It's addictive. It's like, as soon as you have a loan, it's hard to just like pay that off. Most of what happens is you replace it with another loan, and you just become a regular customer to the interest collectors, and so we found that with like we did take a few Amazon based loans, like from Amazon Lending, and yeah, it was just so easy to re-up and keep it, because paying it back at their pace was challenging. But I've successfully paid back multiple ones. Even did one for our private label businesses. We needed a stopgap. But let me jump into the story. So 2021, we were actually pretty cash heavy at that moment. Yes, we were cash heavy. We still kept our like loans around, and we're like, well, what do we do? So a private label business opportunity came up. We got really excited. This is during the aggregator craze. Did that influence us? Probably a little bit. Did my ego come into it? Yeah, it did. I thought I was like Mr. Amazon Kingpin, that anything I touched would grow. Well, the biggest problem was actually that we decided to buy this business while we still had some leverage. Sure, yeah, like everything was trending that we would have cash to pay for everything, but it got way too tight for us. And the business was valued at 1.5. I think we paid like about half up front, if you include the inventory purchase price. And then things just kind of got harder for us. 2022 was a slowdown in some categories, and then like there was capacity limits. All sorts of things were just kind of like hitting us, and so that I look back and I'm like, why did we buy a business when we already had like loans? That was probably my regret, is not buying the business. Like, it's made money, but doing it at the time that we did it. So the reason I thought about this subject is because I probably should have opened with this. I was going to open with this. Is I've looked at all the big Amazon businesses that have stayed around, or the ones that have gone. In about 2015, there was all sorts of like large Amazon businesses. And I think if you look at the top 10, most of them are gone, like gone. There's companies like ThinkFast. There's companies like eTails, which became Caspian, which is gone. Companies, but there's a few that are still around that are probably just kind of the same size, haven't really grown, haven't really shrunk. And maybe like they've done interesting things. There was one company, the two that we looked at first because we were in the toy category, one was called Toys, Games, Etc., and the other one's called Big Fly Sports. Those two, Toys and Games rebranded to River Colony. Those two are still around, and they're kind of like, steady state. I looked at companies like NetRush. I think they've probably grown a little bit. I know they've brought in an advertising tool or agency called Celix. And but there's other businesses that I even mentioned that have like come and gone. Obviously, PharmaPacks, and if there's a unifying feature around them, unprofitable decisions and leverage have got to be there. When I say unprofitable, I mean like buying inventory against Amazon, carrying a lot of doing transactions that just don't make money. If you are a retailer on Amazon, like the reseller category, every single product should make money. You should have zero unprofitable transactions. You probably should argue the same for private label, but sometimes they're playing a different game where you're chasing bestseller ranks and all that jazz. And but even then, it's way better if you could do everything in a profitable perspective. So, I just wanted to share my experience with leverage. Perhaps I know every Amazon business thinks about this at some point. And I really think, you just have to be wise, be a little cautious, because with my next business, I'm allergic to taking on money, allergic for Smart Scout. And it's just been so great to just grow profitably and kind of control our destiny, and just to have that flexibility. We can do whatever we want. We can move into a new category if we want, and we've done that. So, totally recommend that route if at all possible. There are I listen to the Acquired podcast, and when they talk about some of these companies like IKEA or Raising Cane's, I've listened to some episodes on those. It's so awesome to hear businesses that succeed without leverage, and they don't chase the same game that everyone else is forcing them to or thinking. There's been a lot of acquisitions lately, like Poppy, Dr. Squatch, and a lot of those, they're kind of chasing that exit. And you don't have to exit. You can just make money. And, who cares what, happens with those other companies. So, if you have any questions on that, happy to reach out. Reach out to me. If you ever are wondering what funding options, I'll probably tell you. No, I won't. I'll be even-handed. Now, for those that listened till now, you guys are the OGs. You listened to a random haphazard story, but a lot of nuggets in there, and how we lived and experienced our business. So, but this year I'll be in Seattle, Amazon Accelerate. So I was attending Amazon's strategic sellers conferences probably since 2014, maybe 2015. And it was invite only. And we fortunately were big enough or growing fast enough. They invited us and put us on a boat, a little sunset cruise in there in Seattle. It felt like it was pretty cool to be adjacent to Amazon, to be there in the room with them. And I've seen Amazon kind of change their format over the course of the next few years. They did some regional shows, like one in New Orleans that I went to randomly. They've done some others in Seattle. What was it called? Amazon Boost. And then after COVID, they finally landed on what they should have been doing all along. Just a proper, big tech convention or conference. And Amazon Accelerate, when I went to it 2 years ago, I was like, oh, this is legit. This is exactly what they should have been doing. The room with all the software vendors was just huge and big and fun. Amazon does a lot of fun things. After seeing what it takes to run an event with Sellers United, their audio setup, audio visual is their IT is costing them a few $1 million for their setup. It is impressive. It's they're filling the space that they should. This is Amazon, a big, one of the top companies in the world, and we're going to be there actually as a partner for the first time. I'm not supposed to tell you this, but it's pretty expensive. They charge 5 times more than what other conferences do, or more. And so we're excited to be there. We're also doing a sunset cruise. We're hosting it. I was like, you know what? That is the party to do in Seattle. So we will be there. So you can apply to get a free ticket. You probably could just Google, or it's on Eventbrite, this Amazon Accelerate Sunset Cruise. That helps you find it. And yeah, either that, cozy up with one of the sponsors, or you could become a co-sponsor, still accepting 1 or 2 more. And yeah, so excited for Accelerate. It is a good show, and they do a lot of stuff to like keep it entertaining. And the networking is pretty solid, as everyone is on point. It's not, I found it actually better than Prosper, where, I don't know, it just seemed to like have a little bit sharper focus. Oh, also, if you want to actually really interface with Amazon and, you know, solve some issues, I know if you like really dig in, you can meet with, I think they call it the Seller Cafe. And I've heard a lot of good experiences. I've heard some that like have been like, you know, rolled their eyes at the responses that they got, but also some like good responses in terms of dealing with people that actually can solve your issue. So, all right, that's the pod. Thanks everyone for listening, and we'll catch you in the next one.
1, 2, 3.